All right, today is Tuesday, May 25th. This is a recap for the stock market activities today. Before I start, I have two important follow-ups regarding things I said in previous videos. Starting with last night's video. I mentioned in the option strategies I shared with you to hedge your portfolio, specifically selling puts. And I mentioned that you cannot sell what you don't have. This is a little misleading. You can sell what you don't have so long as you have the money in your account, meaning in a put option trade transaction, the buyer is expecting the price to go down, and the buyer has the right to exercise the option by expiration if the price is below the strike price. When the buyer of put options exercises the option, they are obligated to short. They're turning those options into an actual position by shorting the stock. On the other hand, the person selling those put options will be obligated to buy the stock by expiration date if the buyer chooses to exercise their options. The buyer ends up shorting the stock and the seller ends up owning the stock, and therefore you can sell as many put options as you want so long as you have the money in your brokerage account enough to buy the proper quantity of the stock. Meaning, let's say you sell 2 put options contracts. Each contract has 100 options. Each option is a derivative of the stock. Meaning, by selling 2 option contracts, you're obligated to buy 200 shares of the stock if it gets exercised. Let's say the stock is trading at $10 a share, meaning if the option gets exercised, you're obligated to buy $2,000 worth of the stock. So if you don't have $2,000 sitting in your brokerage account, your broker is not going to allow the trade to happen. But if you do, sometimes this strategy is used as in, I am interested in buying the stock, but I am expecting a correction soon, and I want to get paid to buy the stock. Therefore, you sell the put option, you collect that credit, and if you are right, the stock goes down, it goes below the strike price, it expires, and now you buy the shares for that particular strike, and you also get to keep the credit from selling those put options. Therefore, get paid to buy the stock. So I hope this is clear. You can sell as many put options as you want so long as you have the money in your bank account enough to buy the quantity of shares specified in your trade. Follow-up number 2. I discussed with you the chart of the Momentum ETF MTUM a few days ago, and I mentioned that the weekly chart is not looking good, that we could see an oversold bounce from a daily perspective, but the weekly chart remains bearish. Here's an update. The Momentum ETF, which is a $16 billion plus ETF, will reshuffle its holding and update the stocks under the ETF, and they are reducing exposure to technology and momentum, the traditional definition of momentum, meaning high multiple stocks, and they are increasing their exposure to value stocks, specifically in the financial sector. So the Momentum ETF is being updated to reflect the new momentum, value stocks. This is according to them. You can disagree and say, hey, technology still is the momentum. But the folks at the MTUM are saying, we believe that the new momentum is shifting from traditional momentum, technology and high multiple stocks, to old school stocks, value, financials, cyclicals, etc. Now, let's talk about the market, because the market is under a state of confusion. The Federal Reserve is on overdrive mode with the propaganda. Fed speakers on a tour day after day, week after week. This is their job. They tour the country spreading propaganda. And the propaganda is that inflation is transitory, don't worry about it, and even if it is not transitory, we got the tools. You have nothing to worry about. Trust us. And you know, the market is starting to trust the Federal Reserve. The market is starting to say, what if the Fed is right and inflation is indeed transitory? And therefore, you're seeing yields getting crushed today. Yields went all the way down to about 1.55 basis points. You're also seeing a sell-off in commodities, specifically the axis of inflation. You also have confusing macroeconomic data, and the algos, of course, are not accustomed to comb through inflation data because The last time we had inflation was about 40 years ago. So the algos read the headlines and make the assumption that inflation is cooling off. So you have these dynamics that the market has to process. And while yields and the inflationary trade got whacked today, meaning that the market is starting to believe the Fed, this is one aspect, one piece of evidence supporting this theory. But the missing evidence is, where is the outperformance from the NASDAQ and the high multiple names? Because in a day like this, when yields are down significantly and the market appears to be believing the Federal Reserve's propaganda, why haven't the NASDAQ and the momentum names outperformed significantly today? The reason is this state of confusion. The market hears the argument from the Federal Reserve and the propagandists in the media, but it weighs that against the argument from the inflationary camp, who are warning that inflation will not be transitory. There are elements that are transitory. Even the Federal Reserve says it is largely transitory. So what is not largely? What is not largely is the blind spot that either the Federal Reserve is not seeing or choosing to ignore. And this is the psychological element of companies raising prices, and the end customer is okay with that. The psychological element of workers demanding more wages, and that leads to wage inflation. The psychological element that the consumer is expecting higher inflation, and if they are, then they're spending right now before prices go higher. And the market is weighing all of these arguments, and it has one step on the inflationary route and the other foot on the disinflationary route, that inflation will be transitory, and therefore it will be a confusing and a very difficult terrain to navigate in the market in the next few days and weeks. And the reason is we don't have solid macroeconomics data coming out that supports either side. We have Memorial Day weekend coming up, and therefore the Federal Reserve side, the transitory side, are winning for now. And when we talk about confusing data, for example, the housing information that we received in the morning. On paper, the headline says that home sales fell sharply last month. Matter of fact, 1.9% to a rate of 863,000 units. Meanwhile, the expectations were 970,000 units. The algos read the headline, home sales down. You see? Inflation is transitory, but what the algos and the so-called experts are ignoring is the following. Median new home price in April surged 20.1% from a year earlier to $372,400. Furthermore, the Case-Shiller Index showed that home prices are rising in the fastest pace in more than 15 years. Matter of fact, all the way to 2005. We have certain markets, Phoenix, for example, the hottest housing market in the country. Everybody wants to move to Phoenix. And then we have San Diego at number 2. Home prices are up 19.1% year over year. Why are you people moving out here? There's nothing. Trust me. Taxes are still high. It's just like LA, a little nicer. But once again, filth, garbage, homelessness all over the place. Why are you people moving out here? Leave us alone. We don't want you. You're not welcomed here. But perhaps what impressed the deflationary camp and inflation deniers, and you heard the sounds of orgasm all over the place in the disinflationary camp, is the following. When consumers are asked, are you planning to purchase a home? In this survey for April, the percentage of consumers saying that they are planning to buy a home collapsed completely off the face of the earth. So once again, the market is weighing all of that data. Does this mean that consumers are now no longer interested in buying houses at all? And if that is the case, that the demand is gone, then how do you explain the fact that home prices are rising in the fastest pace in 15 years? In addition, isn't the lack of morale between home buyers is due to the fact that the housing market is tight, that prices are too high, and the supply is not here? If I have been looking to buy a house for the last few months and prices keep going higher and higher and higher, at a budget, then now I am priced out of the market. Of course, I'm not interested to buy a home anymore. I want to wait till the bubble pops. The problem is, the way psychology works is the following. You're gonna say, all right, you know what? I'm not buying a house anymore because I am priced out and every offer we submitted got rejected and the house got sold to an all-cash buyer 25% above the asking price. This is crazy, so goodbye. I'm not looking to buy a home anymore. I will start looking for a rent instead, and therefore you're seeing rental properties surging in value. But the way psychology works is the following. I'm saying I'm not buying now, but the moment I realize that prices will continue to go higher and higher, and the bubble is not going to pop anytime soon, a matter of fact, mortgage rates are rising, all of a sudden I'm interested to buy again, and I will go out of my way to borrow money, to take more risk to buy a home. Because the expectations now are that prices will continue to go higher. The bubble is not going to pop, so I better buy now. And that will be perhaps the top in the housing market. And therefore, in this chart, you see these sharp downturns, and these recover right away. Will this one be another one, or will this be different this time around? This is the question that the market has to process. Lastly, before we start, I want to talk about the outperformance today for meme stocks. We know that meme investors migrated from meme stocks to cryptocurrencies after the crash of GameStop, the first episode of the sheep who invaded the market, Diamond Hands, Poodle, all these morons who came out of nowhere. They shifted to cryptocurrencies. Well, now cryptocurrencies are crashing. The question is, are they shifting back to meme stocks? And therefore, we saw GameStop and AMC rising to the tune of 20% today alone. Do they have the momentum and the power, just like they had before, earlier in the year, to maintain a short/gamma squeeze? Or will this be a one-day pop, and now that AMC and GameStop caught some attention, we will start seeing profit-taking and shorts hopping on the trade, adding downward pressure on meme stocks? We will see. But I'm seeing lots of bearish bets against these names today. Anyhow, we got a market to cover, and let's start by the market performance today. And here we go. The Dow Industrial Average closing in the red, down 82.25 points, or decline of 0.24%. The Nasdaq down 4 points, or a decline of 0.03%. The S&P 500 down 8.88 points, or a decline of 0.21%. What about the sector's performance today? Not good, pathetic, and therefore we're not going to give any medals. But anyhow, finishing at number 1 and capturing nothing, consumer defensive. At number 2, for also nothing, consumer cyclicals. And at number 3, for nothing, yet again, technology. Meanwhile, the laggards of the day, and they deserve a slap in the face, not a medal. Number 1, energy. Number 2, materials. And number 3, utilities. But the weakness is evident in the inflationary trade, whether we're talking about energy, materials, industrials, financials, all of these sectors lagging the broader market today. And therefore, I'm saying the market is starting to believe the argument of the Fed. Of course, until the next batch of data negates that. But we know that the data comes out of the kitchen from the Bureau of Labor Statistics. So we will see lots of games being played. What about the advance to decline ratio? The NYSE, 30% advancing versus 67% declining. The Nasdaq, 34% advancing versus 63% declining. All in all, a weak day in the entire market. What about futures? Crude oil futures muted today. We saw a massive rebound yesterday, but today there is no follow-up, and this is very important. Likewise, the axis of inflation, in my opinion, of course, lumber, copper, corn, all sporting massive declines today. With exception of copper, slight declines. Perhaps the correction in copper is reaching an end. But the drop in corn futures is significant. You have that bear flag formation in corn futures, and that is playing out. Now, when it comes to lumber futures, we started to see a massive rebound right after the massive losses. Is that all there is? Was that just a dead cat bounce? We will see. We need a confirmation by tomorrow. Will lumber catch a bid again, or will the weakness we saw in today's session a sign for more pain to come? When it comes to other futures, the picture is just fine, at least in softs for sugar and coffee futures, all closing decisively in the green. Meanwhile, coca, cotton, and OJ futures muted, flat for the day, no activities whatsoever. What about metals? Massive decline for yields today, and gold reaching 1900. We thought that gold is starting to top, but if yields are going to go down and the dollar refuses to pop, then this is the Goldilocks environment for gold. Likewise, a nice upside day for silver futures, but the bulk of the gains came from platinum and palladium futures. What about meats? Forget lumber, forget corn, forget copper. The real deal is the piggies. Lean hogs, aka the new momentum. Until it's not, of course. But no stopping sign here. The demand is high, the supply is not here. This is a classic inflationary story. You can say lumber is rising based on speculations, but you cannot say that about lean hogs futures. Up again today. Likewise, we saw significant gains for feeder cattle futures. Meanwhile, live cattle futures muted for the day. What about grains? We talked about corn, massive declines. But we also saw declines for soybean meal, canola, wheat, and soybeans futures all down for the day. What is outperforming today in grains futures? How about soybean oil futures? Rebounding after massive declines. We also saw gains for oats and rough rice futures. Oats also suffered from a steep correction. The question is, where is the bottom? Is it already here? We will see. We need a confirmation in these rebounds in soybean oil and oats futures. Corn, on the other hand, still looking for a bottom. Moving on to the big casino, the options market. What's going on here? Lots of action, but in smaller names. The overall activities are very quiet, and the casino has been quiet since the retail massacre from the February-March correction. And since then, we continue to witness the options volume declining by the day. But today, we saw an increase, a bump in activities for meme stocks, specifically AMC, leading the day. Not Apple, by the way. AMC, can you believe it? With a little over 900,000 contracts, about 72.6% of those were calls. Now, this is a small stock, so 930,000 contracts, that is a large number. More options were traded for AMC today than it was traded for Apple, which came at number 2 with a little over 680,000 contracts. About 67% of those were calls. Meanwhile, Tesla at number 3 with about 570,000 contracts, about 57% of those were calls. We are seeing more bearish bets starting to form against Tesla. For a while there, the bears stopped betting. They stopped buying put options. They perhaps switched to the other side or booked some gains. And now they're starting to pile up against Tesla once again. And take a look at NEO, for example, Palantir, GameStop, the call options volume exceeding 70% of the total volume traded for these names. That tells us that the appetite for gambling is back again. Retail crowds, perhaps done with cryptos, they got whacked or they took profits, whatever. They're switching back to meme stocks, trying to score in the options market instead. And therefore, I keep telling you, these are not traders, they're not investors, they're not even gamblers. They're zombies high on meth looking for the next score. That's all there is. They're motivated by greed and they are chasing the next pop. That's all what matters to them. Until, of course, they get slaughtered in one bad trade and they're out. What about the unusual trades taking place in the options market today? Starting with the SPY, the S&P 500. And by the way, we're seeing more bets against the SPY. The bearish bets are rising significantly higher, meaning we're seeing lots of insurance buying and we are seeing lots of hedge funds betting against the market. Now, we saw a pop in shorting activities against the SPY last December, and that was a bear trap. The question is, will this one be a bear trap too, or will this be the one? Here we have a high conviction trade, and we say that because it is not clearly an insurance policy, because they're not betting that the SPY is going to collapse. Usually when we see insurance policies being bought, they buy them for steep downside. They're trying to protect their portfolios. But bets against the SPY, bearish bets, usually target anywhere from 5 to 10% correction. They're not looking for a complete collapse in the SPY. In this case, they're buying the 390 puts, expiration date July 2nd, with expectations that the SPY will drop about 7% or more. By then, they paid about $2.75 a piece to enter this trade. All in all, bringing the total to about $7.7 million. Big number. What about the ticker AMC for, AMC? A huge surge in volume, and of course when we see that kind of surges, there are exceptions of course. The first episode in the mania back in February, where you saw massive pops with extreme volume being followed up the next day, but that is usually not the case. For example, talk to any technical analyst. One of the classic signs of a bottoming in any chart is one massive down day gapping down or a massive slide on high volume, panic like selling. Usually that is a sign that the selling is over and the bottom is near. The opposite is true when you usually see massive green days with high volume, everybody piling in to buy. Usually that is a sign for a top because the buying pressure is being exhausted and now you are opening the path for profit takers. You know, the paper hands, not the hoodlers, the paper hands, the ones who make money. They book the profits and you start to see the stock reversing course. This is at least what this trader is betting for. And I followed this trade, by the way, and I did another one for June against AMC. But I also followed this one because the risk versus reward is worth it. Buying the 14.5 puts, expiration date May 28th, meaning this upcoming Friday. So we got 3 days for this trade to work out. And we paid about 45 cents a piece to enter this trade. All in all, spending about $800,000 for this trade alone. Now, even though AMC experienced a lot of short covering by the end of the day, we saw the massive pop by the end of the day. However, these put options, increased in value as the stock started to trade higher and higher. Why is that? The reason is, as the stock started to climb higher impulsively, the vega of put options started to increase. Matter of fact, the vega in the name in AMC started to rise in general. Vega dictates the volatility in the underlying stock. You know, the Greeks, theta, alpha, gamma, etc. When the value of vega rises, the options premiums also rise in anticipation of very large moves to come in a short amount of time. Moving on to the trade for the ticker MU, Micron, down big today, and they are betting for more pain to come for the name by buying the 74 puts, expiration date June 18th, with expectations that the name will drop over 9%. By the expiration date, they paid about 77 cents a piece to enter this trade, all in all bringing the total to about $800,000. What about the trade for the ticker OUT, O-U-T, for Out Front? They're making a bullish bet here by buying the 25 calls, expiration date July 16th. With expectations that the name will rise over 5.5% by then, they paid about 75 cents a piece to enter this trade. All in all, bringing the total to about $800,000. What about the trade for the ticker VLDR? This is yet another LiDAR company. They're making bullish bets here by buying the 12.5 calls, expiration date July 16th. With expectations that the name will climb over 19% by then, they paid about 93 cents a piece to enter this trade. All in all, bringing the total to about $1 million. What about the trade for the ticker NKLA, Nikola, Fraud INC? But hey, there is still money to be made from fraud. At least this is what this trader is betting on by buying the 13 bucks calls, expiration date June 18th. With expectations that the name will climb over 5.5% by then, they paid about 80 cents a piece to enter this trade. All in all, bringing the total to about $700,000. What about the trade for the ticker CAL for Claris? They're buying the 22.5 puts. By the way, this is a luxury shoes company. They're buying the 22.5 puts, expiration date June 18th. With expectations that the name will drop over 8% by then, they paid about $1 a piece to enter this trade. All in all, the total amount spent for this trade is about $700,000. What about the trade for the ticker JWN at the bottom of the table for Nordstrom? And by the way, this appears to be a successful trade because the name is down big after hours. In this case, the trader was betting by buying the 33 puts, expiration date this upcoming Friday, May 28th, with expectations that JWN will drop over 9.5% by then, and they paid about 38 cents a piece to enter this trade. All in all, bringing the total to about $250,000. Moving on to the heat map analysis, and let's see what's going on today. Obviously, the inflationary trade getting whacked, along with yields. Energy down, materials down, industrials down, financials down, massacre across the board. But the other side of the trade that is supposed to be lighting up green like a Christmas tree is not. The big cap technology names are not participating that much. They're pretty much flat. We also saw losses in the technology names and the high multiple names, with some outperformance, the likes of Square, Adobe, some chip manufacturers, AMAT, continues to ride higher, but other than that, it is a reflection of the market's confusion. This is what I see when I look at this map. The market is saying, what do we do here? These fools are not being clear, meaning the Federal Reserve. They keep talking about transitory, but they're not providing any evidence or any guideline, any formula we can follow and predict, hey, the Federal Reserve might start tapering by this date. The Fed is being extremely vague, and they are playing this game, playing poker. Folks, we're not saying, but we are saying. Or we are saying, but we're not saying, playing those mind tricks with the market. Continue to do that for a few more days and a few more weeks, and the market is going to start to throw a fit, because one thing the market doesn't like is the lack of clarity. Moving on to the themes analysis. What about the inflationary trade? The reopening trade. Modest gains across the board, some losses here and there. Modest losses, nothing big. Likewise, the gains also modest, with exception of Royal Caribbean and other cruises. And therefore, I continue to say, stick with experience related stocks, the likes of cruises, for example. We also have massive gains for AMC. We talked about this name in details. And the chart is pretty much consolidating in a range. We're not at the upper range yet. Perhaps the stock will go all the way there and then face some resistance and it starts to turn around. We will see. But for now, we have a defined channel where the stock is trading. So expect that the stock can pop up or collapse all the way down. And therefore, the volatility in this name, the expectations of volatility is increasing significantly. What about the inflationary trade? What's going on here? A bloodbath across the board, some modest declines here and there, but some big. For example, for names like Alcoa. Alcoa is down about 20% from the highs or more. And this is the kind of correction we've been waiting for. Not just in Alcoa, also in Deere and Hubble, Martin Marietta, Westrock, other inflationary names that are not on this list, the likes of Fastenal, for example. All of these inflationary names went too high too fast, becoming overvalued and overbought themselves. We're waiting for this correction. We've been waiting. The question is, are you going to buy now? Because last time around, everybody wanted to wait. Oh, wait a minute. Alcoa is still high. I'm not going to buy right now. I'm waiting for a dip. Well, here's the dip. Are you buying? Of course not, because now you're scared. This is how the psychology works. But if you continue to believe that inflation will continue to rise higher and eventually the market will start to disbelieve the Federal Reserve, then all of these are just dips and they will be bought, and these names will rebound higher once again. And this is, by the way, my bet, absent of new information that will change my mind. What about the low inflation stocks, the disinflationary stocks, the de-inflationary stocks? You can call them whatever you want. They're a combination of high multiple stocks and stocks from certain industries that tend not to do well under high inflation. Again, we're not seeing that massive pop, yields collapsing, the inflationary trade getting whacked. Why are we not seeing the high multiple mania names exploding higher? That remains to be the question. Moving on to the charts analysis, starting with the SPY 30 minutes chart. The SPY facing the resistance from 420. This remains a very strong level of resistance. But has the picture turned bearish from the activities we see from the 30 minutes chart? Of course not. We still have the 417.30 support that has yet to be broken. And for now, we have a bull flag formation that is supposed to take the chart to break above the resistance of 420 eventually, until and unless the 417.30 is broken, and then goodbye to the bull flag, and we will see lower prices for the SPY. Zooming out to the daily chart, the continuous contract, and once again, I keep telling you, you gotta wait for a confirmation here. We have the breakout out of the wedge consolidation, but we don't have the confirmation yet. For all you know, this could be a massive bull trap. And you see the negative divergence in the RSI continuing, along with the negative momentum from the MACD indicator curling back downward. Therefore, you gotta wait for the confirmation. And that will happen in the form of a big update, breaking the resistance of 4,232, reversing the negative divergence in the RSI, and making green impressions in the histogram of the MACD indicator. For me, these will be the signs to confirm that the SPY will march higher and make all-time highs. And this is not a bull trap. What about the Qs? 30 minutes chart, once again consolidating. There is a soft resistance around 335, which happened to be the gap that was already closed. The question is the chart going to pass above that level and face the ultimate resistance of 340? Well, for now, the chart is consolidating in what appears to be a bull flag formation. And the assumption for now is all of this is an effort to gather more momentum and more energy to release to the upside all the way to 340. When does the bullish consolidation theory goes down the toilet? That will happen if the Qs break the support of 330 and a half. What about the daily chart of the continuous contract of the Qs? Once again, we have some confirmation that the momentum has turned from bearish to bullish in the Nasdaq. That confirmation is the positive crossing in the MACD indicator, the positive divergence in the RSI indicator, reversing the negative divergence. But we don't have a confirmation, the third one, perhaps the most important one, which is closing above the top of the reversal candle at around 13,718. The chart attempted to do that today, unsuccessfully, got rejected, closed below that level, not by much. We have a pin-like candle, meaning indecision. Also meaning there is a massive move coming, perhaps as soon as tomorrow, a decisive one, either breaking and capturing the resistance of 13,718 and perhaps beyond that, all the way to 14,000. Or this will be a massive bull trap and you will see the reversal. And that will happen and be confirmed if the Nasdaq futures lose the support of 13,600 and close below that level on daily basis. What about the IWM 30 minutes chart? The IWM has been weaker than the SPY and the Nasdaq yesterday. The weakness was evident, and even though AMC and GameStop, huge components for the IWM, popping higher, the rest of small caps and the reopening names are underperforming, and therefore the IWM is struggling to ride higher. For now, the chart is in no man's land. The support at 218, the resistance is at 223. You're gonna have to wait and watch for a breakout above or below these levels, and then we will have clarity. Speaking of clarity, here is a daily chart of the RUT, the Russell 2000. The bulls are struggling to gather momentum here because the negative divergence in the RSI persists and the MACD indicator is struggling to make a crossing to the positive territory. Likewise, are we seeing a formation of a bear flag which will take the chart all the way down to 2100, and that will be the ultimate test for the Russell 2000? Could it be? Once again, we're waiting and waiting and waiting for the weekly closing either above 2,264 decisively, which will be a win for the bulls, or below 2100 decisively, which will be a win for the bears. What about the Dixie, the dollar index? Tricky Dixie. I'm reading articles in the Wall Street Journal, Bloomberg, CNBC. Everybody's assuming that the US dollar will collapse. That might happen, and perhaps will happen in the long run. But for now, we're going to have a massive pop here if the market decides to reverse and resumes the correction. And I am watching the weekly closing around 90. Will Tricky Dixie close above 90, turning the table against the dollar bear, surprising them with an attack? Or will we see a decisive closing below 90, and that will be a win for dollar bears, and we will have clear ramifications in the stock market when the Dixie closes decisively below 90. From a weekly perspective, certain stocks are going to gain, certain stocks are going to start to realize that the weakness in the US dollar will be beneficial to the bottom line. Now, we'll give you the list. I already gave you the list in a previous video of low dollar stocks, but I will share that with you again if we see by this weekend that the US dollar has closed decisively below 90. And by the way, I received a question last night saying, wouldn't the Fed like it and even advocate for the US dollar to go lower, because this is the last remaining option for the Federal Reserve to face the massive problem of debt in this country. Every other option is pretty much off the table, and the only option available is devaluing the US dollar, and that in turn will help the debt picture in this country. The problem is the Federal Reserve is in a corner. They're mad scientists and they have no clue what they're doing. They want the dollar to be higher because this is their power. Their power, the reason why the Federal Reserve is called the world's central bank and the US dollar is the central currency of the world, is the fact that the US dollar is reliable and strong. But if the US dollar starts to devalue due to the massive amount of debt and printing that confidence and that power that the Federal Reserve has on the global financial system starts to diminish. So once again, the Fed is in a corner. They want the dollar higher for one reason, their core existence, but they also want the US dollar to go lower, because this is the only available way for this amount of debt to be serviced. What about gold? What's going on here? We're expecting a top, but in a day when yields decline significantly. And in addition, the US dollar remains weak, allowing gold to celebrate with a massive day of gains. And what is the next destination here? It could be all the way to 1930. We're not talking about the year 1930. We're talking about 1930, the price. But again, what if today was a bull trap? What if today was a result of the confusion from the market weighing in the Federal Reserve's argument of transitory inflation versus the facts? And that will be quickly reversed the moment we get a piece of data supporting that inflation is not transitory. Again, it is the calm before the storm. The Fed has both feet in different directions. The market is hesitant to make a decisive move one way or the other. But once the facts come out, the data comes out supporting one argument versus the other, whether it is the transitory or not transitory, the market will release all of that energy from the hesitation and the indecision, and it will be one explosive move one way or the other. Of course, that will have ramifications for gold. And here it is. What about yields? The moment you break 1.62, the support, you're going to have to go down all the way to 1.55 basis points. That is the next support. And it looks, and I say looks, because this could reverse too. But for now, the chart is capturing the support of 1.55 basis points. This should be a good short-term support, and we'll take it from there. But if that is broken, then the next destination is 1.5. And that will be an epic battle, because it will decide once and for all whether the transitory argument is alive or dead. What about the TLT bond prices? Scoring significant gains today for about 1% or so. This is big for the TLT, but once again, the move lacks the power, that pop, big volume, lots of short covering, lots of conviction that is not happening yet. We are not at that stage yet. Things could change one way or the other. We're watching a weekly closing above 140 or below 134.5. What about the VIX? The VIX dropped significantly in the morning, but rebounded, and it has this hammerish look for the daily candle, signaling a bottom and a potential for an upcoming pop. What about Apple? 30 minutes perspective. Once again, flat, not doing anything at all. Having a tough time closing above the previous gap at around 127. That appears to be a tougher level of resistance than I might have thought. However, for now, the chart remains bullish. The bulls have the advantage because you have higher highs, you don't have a massive sell-off, you don't have a rejection, the chart is not trading below 125. All you know, this is just a gathering of energy to unlock that move to the upside, to recapture the ultimate destination of 131 for support. Once the higher high pattern is broken, you'll know that Apple is reversing, and perhaps the bears are turning the table and gaining advantage. What about Tesla, the souffle? What's going on here? Nothing definitive one way or the other. We have another pen candle indicating a lack of decision. Usually that indecision is solved right away, and you see a massive pop one way or the other right after an indecision candle like we saw today. And the important levels are 629. This is the first resistance. And then we have 679. This is the ultimate resistance. The support remains at 540. We're watching the negative divergence in the daily RSI and what the MACD indicator is planning to do. It looks like a crossing to the upside, creating green impressions in the histogram, suggesting that Tesla will pop higher. But watch out for a potential of a bull trap. Wait for confirmation. Reversing the negative divergence in the RSI, making green impressions on the histogram of the MACD, and perhaps capturing 629. That will be a green light for Tesla to rally higher. Absent of that, we don't have a confirmation. What's going on in the tulips market? This is where the action is, at least was, the last few days. The price action is stabilizing, and that is good news for crypto bulls, because it is an indication that the majority of the selling pressure is behind us. This is the assumption, not based on facts. We don't know what's going to happen, but this is the assumption. And therefore, the power shifts from bears to bulls, because the bears are almost finished selling. Meanwhile, if we see a gathering in momentum and we see bulls buying the dip, then bulls will outnumber bears, and we will see that selling pressure rotating to become a buying pressure, and that will be a bottom for BTC. And the ultimate test is 42,000. And by the way, sometimes switching to a line chart gives you more perspective. Why is tomorrow an important day for BTC? Matter of fact, tonight, because it is continuous trading. Because the question is, are we seeing a bottoming head and shoulder formation, also known as a reverse head and shoulder formation? If that is the case, then we have a confirmation. This is the bottom. Go ahead and buy, and BTC will face the ultimate resistance of 42,000. Absent of that, forming the left shoulder, right shoulder, I don't want to flip my head upside down, get a headache, but absent of forming the other shoulder, for all you know, this is a bull trap, and BTC will go down and retest 30,000 once again. What about Doge? Clean chart, no markings or annotations by me beside showing you the pumps of the con man, which were already here, by the way. But how about this? We have a descending consolidation line that has been broken to the upside. We're seeing higher highs. We're seeing a bull flag formation. Everything is setting up like a rocket on SpaceX launchpad, waiting for a tweet from Reverend Elon Musk. And to the moon, bro. To infinity and beyond. Suck it, Bitcoiners, cum rocketers, poop coiners, and crypto methers. Screw you. Doge is the real deal. We're just waiting. We're waiting for Reverend Elon to pump higher. What about ETH? Ethereum, still indecision. Tomorrow will be an extremely important day for cryptos in general, but for ETH in particular. Because will it be the day where ETH recaptures 2,900, which was the level, the important level to keep? We talked about 2,900. The moment you break that level, the floodgates will open. So recapturing that level of support, closing the floodgates, that will enable the chart to start another bullish run higher. But it also depends on the sentiment. If the rocketers and the coiners are moving on from cryptos back to meme stocks, the likes of GME and AMC, then who's going to push these tulips higher? Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? Nothing. Nada. Niente. Meaning the path of least resistance is higher. So if the market fails to rise higher tomorrow, it's a bad signal. And what about this, by the way? The level of risk-taking is absolutely stunning. I'll leave you with this. The negative credit balance has reached all-time highs. Everybody's borrowing money and gambling in the casino with borrowed money. They're lucky that Al Capone is still not alive, because the threat of bankruptcy and losing all your money perhaps not scary enough. And therefore, you're seeing this massive risk tolerance in the market. But I keep saying, the risk tolerance will be tested, the biggest test yet. What if we get a piece of data suggesting that inflation is not transitory? What if it is a big one? Immediately, the market will turn into the taper tantrum mode, and you will see a massive sell-off in the stock market by the tune of thousands of points on the Dow Industrial Average. The Fed says, folks, don't leave the casino. Rest assured, we will let you know in advance when we're going to taper. You know, the tapering that we're not thinking about anything about it. But we'll let you know when we decide to think about it. Forget about it, I say. Because the market will throw a Fed right away, way ahead of the warning, if it sees tapering on the horizon. Now, the opposite is true, by the way. If we get a piece of data that inflation is perhaps transitory, as the Fed might suggest, then you will see the market popping higher significantly. Therefore, it is a difficult terrain to navigate. But for all we know, right now, we have a lot of action ahead of us. And action is what we wait for as traders, isn't it? That's all I got for you tonight, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.